In this presentation, we will continue on with the second part, part 2 of our fairly comprehensive problem related to the debt service fund, the capital project fund, and the government-wide activities. 2 years of operations. We entered the first year of operations in the prior presentation, part 1 of the 2 parts, and we did the closing process. Now we're going to continue on with the activity in part 2, year 2. First, we're going to enter the budgeting information for the debt service fund, and therefore, as we normally start on the government-wide activity, it being on the accrual basis, and therefore what we're most used to, and then move over to the fund accounting, that being our normal process. Here, of course, we don't have anything in the government-wide activity because we don't typically post the budget in normal accrual accounting, which is what is used in the government-wide activities. Therefore, no activity here in the government-wide activities. How about the capital projects fund? Well, this is going to be the budget related to the debt service fund, therefore no activity in the capital projects fund. We're going to move over to the debt service fund. Within the debt service fund, we're going to post the budget. So this is going to be something we do on the modified accrual basis. We don't see this in normal accrual typically, but we want to be able to see what the budget will be here. Therefore, let's take a look at the accounts. If we go through the blue accounts, the dark blue accounts, the income statement type of accounts, those that are temporary accounts, those would typically close out to what would be the equity section in a for-profit organization, closing out the fund balance here. Let's look for those items that are going to be the estimating items or the budgetary accounts. That's going to include the estimated revenue because it says estimated. And then we have the estimated other financing sources, budgetary accounts given away by the fact that they say estimate. And then we have the appropriations, should be kind of related to the expenditures or expenses, even though they don't sound like expenditures or expenses, appropriations. If we record this out, then we're going to say that the first item is the estimated revenue. Now, revenue has a credit balance, therefore the estimated revenue is going to have a debit balance. We put it on the books with a debit. Then we have the appropriations. Appropriations kind of related to the expenses or expenditures. In this case, expenditures typically having a debit balance. Therefore, the related budgetary account, the appropriations account having a credit balance. Difference between the two going to the budgetary fund balance. So if we record this out, then we're going to say that the estimated revenues is going up in the debit direction with the 190 debit. Then we have the appropriations down below. It's going up in the credit direction. And then, of course, we have the difference between the two, it being the $30,800 in the budgetary fund balance. That ties us out. That puts us in balance indicated by the green zeros. Moving on to the next item, we are back into the government-wide activities. We have the sales tax collections for the debt service. So we have sales tax. That's going to be a type of revenue because we're the government, so we have taxes as a kind of revenue. And we're collecting it specifically for the servicing of the debt. So if we record this in the government-wide activities, the entity as a whole type of activities, we're going to debit the cash. Cash is increasing because we're collecting the sales tax. The other side going to some type of revenue because that's how we make money when we're the government. We tax people. That's going to be our revenue account. If we post this out, then, of course, the cash is going to be increasing in the debit direction. The other side being the revenue account, revenue going up in the credit direction as we see here. Then we want to take a look at this transaction on the government-wide activity and think, what's going to happen on the fund side of things? Well, on the fund side of things, because this was debt, or this was information, this was taxes that are going to be marked for the debt service fund, then we're going to be putting this into the debt service fund in a similar type fashion. How about the capital project fund? Nothing happening there because we're allocating this to the debt service fund. So if we go to the debt service fund, then similar transaction looks much the same. Cash is going up. We have the increase in the cash, and the other side going to revenue. So we have cash increasing over here with a debit to cash. And of course, the other side then going to the revenue account, it then increasing in the credit direction, that putting us back in balance, back to the government-wide activities. We have the billing for the construction project. So you'll recall that we're putting together a construction project. It's going to be a building or some type of large construction project. We've got $700,000 billing from the contractor that we already had an agreement with to finish the job, but they're going to have billing along the way, the billing being that $700,000 government-wide activities, the accrual type, normal type of accrual accounting, job cost kind of system we're using here, debiting then the asset, not the building that's going to be made or whatever the project that's being worked on, but the in-process account, still an asset, work in process, credit then going to the contracts payable account, showing that we owe the contractor, we have not yet paid them, but we are recording the billing of it. So we have the construction work in progress, that being the debit. We increase the construction work in progress. The other side going to the contracts payable liability account, increasing as well. Then we take a look at this on the government-wide level, on the accrual basis, say what's going to happen on the modified accrual, the funds side of thing. Well, this is going to go into the contracts fund, because this is going to be the contracts, or the capital projects fund, we should say, because it's related to the construction contract. So it's going to go into the capital projects fund. However, we're not going to be debiting the construction work in process, but instead crediting or debiting some other account, possibly, most likely, the expenditures type of account showing the flows. Before we do so, however, we're also going to have to reverse the encumbrances, because you'll recall that we put the whole construction contract before anything was done, in essence, estimating it in the format of encumbrances, a holding account, until we get the expenditures. Let's take a look at it. Here's the encumbrances. It's on the books. We basically estimated the whole cost of the building, put it on the books at the point in time we signed the contract, before we're allowed to put on the books the expenditures for work that's actually been done. Now we can put on the books the expenditures for work that's actually been done in accordance with the accrual or modified accrual basis in this case. Before we do so, however, we need to reverse the encumbrances. So we're going to do that first, not all of them, just the amount that related to the progress billing that we have at this point in time. We're going to debit the encumbrances outstanding. Here's the encumbrances outstanding. It's got a credit. We're going to debit it, making it go down. And then the other side, it's going to go to encumbrances. Again, this one looks a little bit funny, of course, because it looks kind of like an expense. And expenses only go up, and now we're making it go down, which is kind of funny. But it's more like a clearing account, because it's a holding account until we can record the expense. So there we have that. We've decreased it here. We're not done with the job. We still have encumbrances outstanding. We still have progress billing due as we make this construction project. Now we can record the expenditure, however, related to this portion of it. We will do that with a debit to the construction expenditures, and it should look a little bit funny because we're making a capital we're making like a building. You would think it would be going into like an asset account under normal accrual accounting, but here we're basically looking at the flow, what's happening of this construction project. Therefore, it's going into the temporary account, the construction expenditure. The credit then go into the contracts payable. If we record this out, we've got the construction expenditures down below, it going up in the debit direction. We have the contracts payable, it being a liability, going up in the credit direction. We have the contracts payable on the books because it's related to the construction contract, and therefore typically thought of as short term. It's going to be like a current liability, as opposed to like a bond, which we wouldn't put on the books on the capital project fund because it would be long term, not in alignment with the modified accrual method used in the fund accounting governmental funds. Back to the government-wide activity. Now we have landscaping that's going to be done related to our capital project, but not part of the billing or not part of the estimate that we made in the capital project. So it wasn't included then in encumbrances. Doesn't matter here for the government-wide activity because we didn't record encumbrances, because you don't normally do that with normal accrual accounting as is being used with the government-wide type of activities. Therefore, we're just going to record the landscaping. It's going to be increasing the construction work in process because it's going to be part of the capital asset that we're making, the building or the project or the big thing that we're doing, the big project we're doing. And then the other side's going to go to cash. So we're going to pay for the landscaping. We're going to debit and increase the construction work in process like so. Then we're going to credit the cash, decreasing the cash we paid for it like so, bringing us back in balance. What are we going to do then to the other funds, the fund side of things then? Well, of course, this is going to be with the capital projects fund because we're dealing with the capital projects. It's going to look much the same with the cash, but the construction work in process isn't going to go to the asset account. It's going to go to an expenditure account. And we don't have to deal with the encumbrance. Why? Because this isn't part of the original estimate. This is outside the original estimates and therefore was not encumbered. And therefore we don't reverse the encumbrance before recording the expenditures because this amount isn't included in this number here, the encumbrance amount, which we put on the books at the beginning of the contract. So we're just going to go straight to the construction expenditure, debiting the construction expenditure and crediting the cash. That'll look like this. We're going to say that the construction expenditure is going to be debited instead of the asset of work in process or building or something like that. We then credit the cash. Cash then decreasing like so. And then what about the debt service fund? Well, nothing's happening to the debt. We're not dealing with anything related to the debt. Then we go back to the government-wide activities. Next item, we have the final payment made on the construction project. So we're going to make the final payment on the construction project. You'll note that we owe the $700,000 and the $64,000 for the contract payable retainer that we took in place. Therefore, that's what we're going to pay out. So these are on the books as a credit. We need to take them off the books because we're going to pay them. Therefore, they will be removed. The other side then go into cash, cash being the credit. If we post this out, then we're going to say that the contracts payable will be debited $700, the contracts payable retained portion debited $64. That was taking those two accounts down to $0. And then the other side going to cash, cash going down because we're paying off the contractor for the work that was done. They did a great job. And then what's going to happen on the fund side of things, when we think about the fund side of things, it's going to be in the contracts, it's going to be in the capital projects fund, and it will look much the same. So it'll look much the same because the liabilities on the books in the capital projects fund, because it's a short-term liability, a current liability as opposed to a long-term liability, and therefore they're still there with a modified accrual basis. So if we go then to the capital projects fund, we will see the transaction looking much the same. We're going to take these two items off the books. They're on the books at the 700 and the 64. We're going to debit them, the 764, taking them down from there to 0. Then the other side is going to go to the cash. Cash then on the books has a debit. We credit it, cash then going down. What about the debt service fund? We didn't do anything with the debt. Nothing's going to happen to the debt service fund. Then we're going to go back to the government-wide activities where we have the debt service payments made. So we're going to make the payments now on the bonds payable. So you'll recall we had these bonds payable on the books, government-wide activities, the liabilities on the books here because it's on the accrual basis even though it's long-term. And then we have the premium on the books because we sold it at a premium. And so now we're going to record the interest related to it. The interest is going to be recorded such as this. We're gonna pay the payment that we need to make, the 192. We're gonna say that the bond payable, we're actually paying off part of the bond payable, so we're paying off part of the principal of the bond payable in this case, and we're paying the interest portion and the reduction in the premium. So we're gonna pay the 1,600 is gonna be the reduction in the premium, and we have the expense for the interest at the 30,400. So in other words, let's recap this again. Normally, when we make the payment of the bonds, we might just be paying the cash and then allocating that payment between principal and interest. Here, we're actually paying off some of the bonds, some of the principal of the bonds. We're paying off some of the bond payable, the $160,000, as well as recording the payments of the interest that we've split out between the reduction in the principal and the interest. So if we consider that then, if we record that out, we're going to say that the bonds payable is going to go down by the 160. That's the face amount that's going down because we're actually paying off some of the bonds. And then we have the premium. The premium is decreasing by this amount with a debit. And then we have the interest expense down below. That's going to be on what would be kind of like the income statement type of accounts. And then, of course, cash is decreasing. Here's cash. Cash is going down as well. Then we want to pull this apart and say, well, what's going to happen on the fund accounting side of things? Now, although this bond that we took out was for the capital project fund, to finance the capital project fund, we are not going to record this in the capital project fund because we're dealing with the financing of the bond. This is going to go to the debt service fund. And so we're going to be dealing with the debt service fund. Within the debt service fund, although we paid off part of the bonds here, we paid some of the bonds off, the payable off. We're not going to record that in the debt service fund because it's going to be on a modified accrual basis. That account won't be there. So we're going to have to do that something else with that number. And then we're going to have the expense. We know the cash is going to go down. So let's take a look at what that'll look like. What's going to happen to the capital projects fund? Nothing. Nothing's going to happen there. Although we took the bond out for the capital project, we're not recording this information related to the service of the bond in the capital projects. It's going to be here in the debt service fund. What happens in the debt service fund? Well, we're going to have the cash going down at the 192. Then we're going to be debiting some type of expenditure. We're going to break out the expenditures between interest and principal. So you'll recall last time we paid off $160,000 of principal, reducing the liability in the debt service fund. This time we're going to put it to an expenditure because we're on the modified accrual basis. And then we had the interest broken out between the reduction in the premium, as we would with normal accrual accounting, and the related interest as well. Here we don't have the premium on the books because we didn't record the premium on the books because it's a modified accrual basis. Therefore, the whole thing's going to go into the 32 for the interest, the 160 for the principal, and the credit to cash. So if we record this out, then we have the expenditure for interest, the expenditure for principal going here and there and here and there. So those go up in the debit direction. Cash then decreasing for the amount that was paid. Back to the government-wide activities, and we say that next thing that's going to happen is the construction project was declared complete. All capital projects funds are closed, and the remaining cash balance is transferred to the debt service fund. Must amend the debt service budget because the transfer was not anticipated. So we're going to basically finish up the capital project. We'll do that on the government-wide activities. Then we'll think about what happens in the capital project fund because we might have some left over in the capital projects fund, and we'll have to do something with that. But first, we're in the government-wide activities. We're going to say that the capital project is done under normal accrual type of accounting. If we're doing like a job cost type of system, which we're kind of doing here, we're going to say, well, the work in process account is now done. That's going to be an asset because that's where we put all the stuff when we were making the building into the work in process. It's now completed, so we're going to take it out of the work in process one asset account and just move it up to the asset that was actually done, the asset we actually made that is now complete, that being, in this case, a building. So we're going to take it out of the work in process and put it into the building. The work in process has a debit in it, so we're going to credit it to make it go down. Then we're going to debit the building, and that'll make it go up. So we're just going to say that one asset is going down, the work in process is going down, and one asset is going up, and that's going to be the building. The building is going up or has gone up, and now the account's going up as well. Capital Projects Fund. So within the Capital Projects Fund, this is used to track the flow of the activity that's used in order to make the capital project, in this case, a building. And now it's been completed. We're done with the capital project. And you'll note that we have money that's left over within the capital project. Well, we don't need that anymore. So we need to take it out of the capital project and put it back into the debt service fund. It's going to go to the debt service fund because we probably have outstanding debt and financing of the debt, interest, and stuff we owe in relation to the capital project. So when we set this up, we started the capital project fund, then we started the debt service fund to kind of service the debt that we're going to use for the capital project. Capital project now done. Any money that's left over, we're going to transfer from the capital project to the debt service fund to pay off the remaining and outstanding debt related to it. Therefore, we're going to have the other financing sources transfer out for the amount that's in the account right now, the $1,050,000, and then we're going to credit cash. So cash is going to go down. We're going to take that out because this one has been completed. We're going to put that into the activity type of acts like an expense type of an account. The other financing uses, interfund transfer out. So that's going to go up in the debit direction, kind of like an expense. Next thing we're going to do is start through the closing process. So if we start to close this out, then we're going to say the other financing uses, we're going to close that out to the fund balance assigned. So we're going to close it out to the fund balance assigned. Therefore, if we record this out, we're going to say that the other financing uses here is going to be closed out, making it go to zero. Then we're going to transfer to the other financing, to the fund balance assigned. Fund balance assigned. There we have that. And now you'll note, of course, that the capital project fund is completed. The capital project fund has served its purpose. So we could close out the capital project fund at this point in time. There's not going to be any more activity in it in the future, given the fact the capital project has now been completed. So now we'll close out the capital project fund, and you'll see that this is what we have left in it. We've already transferred the cash out. So now we can basically transfer out the rest of what's in there, and everything will basically zero out. So we have the encumbrances. Notice the encumbrances are here. They're here. Those are the things you might say, well, we don't normally close out the encumbrances. Well, we didn't use all the encumbrances here, but the project's done. So we're going to reverse the encumbrances. So this wasn't done in year one. We didn't close out the encumbrances because they're still hanging out there because the capital project was still going and we were expecting to use them in terms of actual expenditures. They're still here now after year two. Project's done. Encumbrances no longer serve a purpose. We're going to reverse them. So they reverse exactly, of course. And then we have the construction expenditures. We're going to close them out, and we're going to close them out to the fund balance. That'll zero everything out. So We have the encumbrances down here. It has a debit balance. We're going to credit it. In other words, we have the 100 or 820,000 construction expenditure. It's a debit. We're going to credit it to make it go down to zero. And then we're going to take these guys off the books as well, exactly as they're here. So we've got the encumbrances credit. We're going to debit it. We got the 50,000 credit. We're going to debit it. We got the 770 credit. We're going to debit it. That ties out debits equal to credits and this journal entry, of course. And so we're going to post this out, and that will close everything out as we post it, ending out with ending balances of 0, now showing capital project done. No need for it any longer. What about the debt service fund? Well, within the debt service fund, we're gonna have the transfer from the capital project fund into the debt service fund now to help to finance whatever financing we need to be done within the debt service fund for debt that was set up for the capital project. So we're going to increase the debt service fund by the cash of the $1,050,000 that was transferred from the capital project fund. The credit then now going to other financing sources, inter-fund transfer in, as opposed to other financing uses as it was in on the other side of the capital project fund. And that's going to act kind of like a revenue type of account. So we're going to say cash is going to go up, cash increases, and then the other side, other financing sources, inter-fund transfer in, is going to be a credit. It acts kind of like an income, increasing what would be similar to net income. Next thing we're going to say is, hey, we didn't know that this other financing source was going to happen when we did the budget. And so we're going to adjust the budget to include this thing that just happened now. And this seems kind of funny because you might be saying, well, it's kind of after the fact. We have the budget. We don't know what's going to happen. Now we know this is going to happen. We're just going to adjust the budget. Yeah, that's what we're basically going to do. We're going to say this amount we didn't know about in the budget because we didn't plan for the fact that we're going to have some money left over in the capital projects fund, but now we do. So we transferred it in here, and we're just going to fix the budget like after the fact right now. And so now we're going to adjust the budget. So we're going to say the estimated other financing sources, the estimate, right, is going to be going up by the $1,050,000, showing the fact that that's the leftover money that was in the capital project fund. And then we're going to credit the budgetary, like equity kind of similar type of account, the budgetary fund balance. So if we record this out, then we're going to debit the estimated other financing sources. That's going to be this item, so that we're going to make our budgetary account match now. And then we have the other side going to the budgetary fund balance. So we adjusted our budget accounts then.